The Money Show.
Personal Finance with Warren Ingram.
Now, I want to know this evening, when you receive your salary during payday, are you still feeling as good as you did last year? Is this something that still excites you, or something that gives you anxiety these days because inflation is so high, interest rates are so high, and you're feeling your salary is not as good as it used to be? And that's exactly what we're talking about on Personal Finance, how you can protect your money from inflation. Share some of your experiences with money. You can remain anonymous. Call us on 011-883-0702 or 021-446-0567. Maybe you have some questions for Warren on how to protect your money from inflation, and he joins me now. Warren, my 100 Rand definitely felt better last year than it did this year. This year, I'm quite sure that I can only get a drink, probably with some crisps from 100 Rand.
You're absolutely right. And the problem is we don't kind of get like this major alert, on your phone beeping at you to say, oh, by the way, your money's just worth a bit less than it was last week or last year. So to me, inflation kind of creeps up on us. And then all of a sudden, one day we wake up going, I'm feeling a lot poorer than I was a little while ago. And I'm not earning less than I was a little while ago. What's going on? And I try to, I think, I hate jargon, and I always think, a lot of people don't really know. We know what the phrase inflation's about, but we don't really know like a concrete example. So I did a bit of homework for the show, and I was never good at homework as a kid at school, but I did it just for you. So I looked at what does a burger cost at kind of, one of South Africa's big steakhouses. And 5 years ago, they sold a burger, and it's kind of their generic burger, for 48 Rand 90. So 2018, you buy that burger, 48 Rand and 90 cents. You go and buy it today, and you're paying 99 Rand and 50 cents. So it's the same thing. It's not like they made the meat twice as good or made the bun twice as big. It's exactly the same. Probably it's a bit smaller. In fact, it's called
shrinkflation.
Yeah. And so you're getting the same thing at twice the price in a period of 5 years. Now, if something doubles on you in a 5-year period, the compounding of that is it's compounding at 15% a year. So I'm always looking for investments that are compounding at 15% a year, because I know I'm doubling my money every 5 years, and that's great. Then you start to feel pretty good about life. But all of a sudden, our burgers are doubling against us every 5 years. And I'm not being unfair to the burger joint. That's kind of what's happening everywhere. It's all of our cost of living. And I know food has kind of gone through a patch, thanks to the Russian invasion of Ukraine, that's caused certain kind of food items to go up a lot faster than they would normally do. But we're living with this issue. And so inflation's not just an academic concept, that some guy talks about on the radio or that you read in a textbook. It even makes our burgers go against us at doubling every 5 years. So it is real, and we do need to deal with it. And unfortunately, putting our heads in the sand and kind of not worrying about this is not going to work, because that means next 5 years you're going to need to buy half a burger, because that's all you'll be able to buy.
So it's not a good time to have our money in cash stashed away somewhere waiting for inflation to be better. How do we put our money to work and make sure that we can grow it during this high inflationary time?
Yeah, you're right. So let's just talk about cash for 1 second. The nice thing about cash is you put your money in the account, and every day or every week or every month you look at your app and you see it's just gone up, and you feel kind of good about that because nothing's gone down. The problem is when you look at the returns that you get from interest, interest barely beats inflation. In fact, over long periods of time, it might beat inflation by about 0.5% a year. And then you got to pay tax on that interest, because SARS doesn't let you earn the interest without taking their pound of flesh. So the moment you take tax into account, you're probably going backwards by about 3 or 4% a year against inflation. So whatever you do, cash is not the place to beat inflation. However, we all need a bit of cash. We need an emergency fund. And so you need to shop around now. You need to kind of, go and find those high yielding money market accounts on your bank, or some kind of a high interest savings account, something where you can earn the most interest you can. But unfortunately, you need to shop around a bit more. And so one of my other favorites, and it's actually given to us by our beloved government, are things called RSA retail savings bonds. Now, these are kind of like a fixed deposit, and at the moment, if you invested in one for the next 2 years, you would be able to earn about 9.25% a year. I'm saying about, it's not. It's exactly 9.25% a year for the next 2 years. That's not bad, especially if you're kind of a bit older, over 65, and you can earn a bit more interest without paying so much tax. Not a bad deal. But if you're younger and you're going to pay tax on that, you might be giving away half of that. So it's still not a great deal, but it's the best I can find. It's the best interest-paying thing I can find, guaranteed by our government. I think our government will still be around in the next few years. I'm sure they'll still be able to
trust
honor the interest.
Will.
So I think they'll be okay. So that's probably our first thing is, if you're going to earn interest, earn the most you can. But I think you've got to buy, I'm going to call them productive assets. You've got to buy things that grow faster than inflation, and those come with a bit of risk, because we're talking about the stock market. We're talking about buying shares in companies that have a history of doing better than inflation, and over long periods of time, the stock market beats inflation by about 6% a year, 5 to 6% a year. Unfortunately, it doesn't do it in a nice kind of straight line. It does it like a roller coaster. So one year you're doing 3 times better than inflation, and the next year you're losing against inflation. But over long periods of time, 6% a year. That's a
Someone
good deal.
might then
remember,
say, Pavlo, if I can just jump in there, that I've got this cash. I don't exactly know what's happening on the stock market. I'm afraid to lose the amount of money that I do have. What are some of the sure bet ways? I know the stock market is not really straightforward, but some of the safest ways you can put your money there and expect some form of return.
You've got to go you've got to avoid playing Russian roulette with your money. In other words, don't bet all of your money on one share or 2 shares. You're going to have to kind of spread your exposure to the stock market around. And kind of 2 favorite ways I've got is, one, invest in the index. So we all know about like the top 40 index now, where you can buy one exchange traded fund or one unit trust, and what it does is it goes and buys the 40 biggest shares on the stock exchange. That's a very efficient, kind of very certain way of getting the return of the stock market, and over long periods of time will give you the return we're talking about. So that's one way. The other way is go and buy a general equity unit trust. It's a bit of jargon, but it's a unit trust, and it's a category of unit trust that only buy shares on the stock market. And for me, not a bad way to go. So you might say, well, let me do half into the index, half into a general equity unit trust. And that for me is a good spread of assets. And maybe, if you really want to spread your risks properly, then maybe you go and buy a world index, index tracker as well, or a world index unit trust as well. You have a spread of those, and then you're cooking.
We're in conversation with Warren Ingram, co-founder of Galileo Capital, in our personal finance feature tonight. We're talking how you can protect your money from inflation, the different ways and tricks and some of the formalized ways in the markets you can use to earn on your inflation instead of keeping your cash stashed away under a mattress somewhere. So we'll pick up on this conversation after this.
The Money Show. Personal finance with Warren Ingram.
The Money Show with myself, Mateo Khoripe, standing in for Bruce's. We pick up the conversation now with Warren Ingram, co-founder at Galileo Capital, talking personal finance and how you can protect your money from inflation. Let's look at the other productive assets like property, where you can put your money to get some healthy returns.
So if we look at things outside of the stock market, we're starting to look at assets that are a little bit less liquid, and liquid's important here because we're talking about things that aren't necessarily as easy to sell quickly, and so if we look at property and whether it's residential or commercial in South Africa, it and actually all around the world, it does have a history of beating inflation. Probably not a Joburg property over the last 9 or 10 years, unfortunately, but generally the property market will do better than inflation. One kind of quirky one, but because I don't really know how easy it is to invest in, but what's really interesting over the last sort of 10, 15
Warren?
Is killing inflation.
Yeah. I think we lost you there a little bit. If you can just take us back to the 10 and 15 years, one that is killing inflation, which property segment is that?
Oh, we broke on the key parts. It's actually farmland. So, farmland in South Africa and farmland around the world has been, doing really well. And so that's to me a quirky one, but actually doing really well. So if you are a farmer, you might not be making a lot of money from your actual farming operation, but you are making money from the land. And so that's an interesting one. And then I think another one would be businesses. So actually not shares on the stock exchange, but normal companies that are, that you buy from business owners directly. And there you're going to have to do your homework because, not all businesses are going to succeed. In fact, most businesses will fail. But the good ones, they will be delivering inflation-beating returns.
When we look at those inflation-beating returns, especially in South Africa, when it's got to do with property, most of the great numbers are found in Cape Town, and even then you need to be heavily cash flush. While on the other hand, we have people talking about flipping small properties or turning them into Airbnbs. What other opportunities are there in this particular market?
So you're right. I think we're not talking about being kind of a passive investor. In other words, where you just buy something and forget about it and hope it's going to go up.
Warren, I'm sorry, I'm going to have to ask you to just pick it up again in terms of those key points on not being a passive investor when it comes to property. How can you actively make your money back here?
Yeah, you're going to have to treat it as a real side hustle, as a proper side business. Where as you say, you run it as kind of an Airbnb, or you buy something, you do it up and you sell it. But you're going to need to do your homework. You're going to need to be very selective in terms of where you're doing that. Very high value properties in Joburg are not the place to do it right now, but kind of, the lower value property where there is bigger demand and finding it in the right area. I think, that would make sense. I'm not sure I'd want to be, jumping into the Cape Town property market now. I think it was a great place to be 5 years ago, but
so it's a bit late
for
now.
Those areas. Yeah, it's too late, and you got to look at where will value be unlocked. I'm looking at those massive bridges that are going to be built in the Eastern Cape, and I'm thinking to myself, when that highway is now working on the N2, is that an opportunity? I don't know. Property experts are going to have to do some homework on that, but it's things like that are offering an opportunity that didn't exist 5 years ago. But don't go and buy what everyone else sold a while ago, because that's just too late. You're kind of running in after everything's kind of left and the opportunities are gone.
One of the key ways to have more money on hand to even invest is to actually rid yourself of debt. And that, we've got a listener question this week, Desiree actually saying, my father is struggling with some debts at the moment. He has a personal loan, an overdraft, credit card debt, and a home loan. What should he do with these debts?
So it sounds like a problem a lot of our country is dealing with, and so I think when you look at this, you've got to understand which of those debts that you've got, if you've got a few, which one costs you the most interest every month. And I think often we look at the one that costs us the most rand. So you'll say this one cost me 10,000 rand, and that one only cost me 200 rand. But that's not necessarily the way to look at it. You've got to look at which one's charging the highest rate of interest. So if you've got a home loan, that might be costing you 11% a year, but your credit card might be costing you 25% a year. And so the game plan with debt is to say, find the one that charges me the highest rate of interest and try and find a bit of extra money every month to settle that one as fast as I possibly can. And then you work in descending order. So you're saying, well, if it's credit card first, then look at what's the interest rate on the overdraft versus the personal loan. And the money that you're now got free from the paid off credit card, you put all of that into the overdraft. Once that's down, you put it all into the personal loan, and once that's down, then you can start to pay down your home loan a bit faster. The trick with debt, though, is don't ignore the home loan. So don't stop paying the home loan to try and settle the credit card, because that means you lose your home. So what you've got to do is, pay the minimum required, whatever the bank actually wants from you on a monthly basis on all of the debts, and then pay the extra on the one that's costing you the highest rate of interest. You've got to be strategic on this. You can't just put your head in the sand and hope that the debt problem goes away.
Yeah,
you've got to take it on its head and actually, have a game plan. It can be really simple, but make sure that you understand what those interest rates are. The banks will tell you what they are and might be on your banking profile already, but don't be afraid to ask the questions and be clear on what this is all costing you.
And someone might rush to say, I'm going to get a consolidated loan and try to pay all of these things off. What should they consider before getting that consolidated loan?
It's going to take a little bit of honesty. You're going to have to look in the mirror and ask yourself why are you in this situation? And so taking a consolidation, what you're actually doing is you're taking on even more debt, and now you're lumping it all together. And so you're let's say you owed 100,000 across all of the debts. Now you might end up owing 120,000. And so if you are disciplined with debt and that interest rate is going to be lower on the consolidated level than it is in all of these different little pieces, then look at the consolidation. It might not be a bad idea. But you might find, you've got credit card debt for 25,000 Rand and you've got some other debt for 200,000 Rand, and the consolidation will be at the same rate as you were paying, on the credit card debt. And then it's really not a good idea, because suddenly you're paying much more interest on a much bigger amount. So you've got to get a really clear idea, do the proper maths, work it out to rands and cents as to what it will cost you to pay off that debt on a monthly basis if you consolidate. But the honesty part is understanding why. Did you get into this trouble because you weren't disciplined with money, or was it something that was just really bad luck? And bad luck is not, some brand just dropped a new pair of shoes and I absolutely had to have it. Bad luck is I lost my job because of COVID. That's bad luck. Not buying stuff that you don't need. And so just understanding, that if you're not disciplined with debt, then don't do the debt consolidation. Go and pay off each item, item by item by item, and until you've paid it down, and then you cut up all your credit cards and you don't get debt again because you're not good at it. But for someone that's normally fine and just got really bad luck and the debt consolidation interest.
All right, we seem to have lost Warren there, but I'm sure a lot of you have gotten the gist around how to protect your money from inflation. Warren Ingram, the co-founder of Galileo Capital, in our personal finance feature tonight. Thank you very, very much.